First of all, my name is Huw van Steenis. Thank you so much for inviting me this morning. Probably the best known banker in history is not Cosimo de' Medici or Jamie Dimon, but Mr. Banks in Mary Poppins, who I'm sure you all know. When his son Michael is taken to the bank where his father works to deposit his tuppence, he's having none of this. "Give me back my money," he squeals. And the lady next door to him sees what he's saying and says, "They're not giving that boy his money back. I want my money back." And so on, and promptly causes a run on the bank. This, for me, underscores one of the most important lessons in financial history. Money is all about trust. Whether it's a credit card, a banknote, a Bitcoin, or a stable coin, what underscores this, these tokens have value because society gives them so. And so that makes real change in financial history actually quite rare. The real revolutions in financial history have been relatively modest and few, such as the change from a coin to a banknote, which underscored an explosion in international trade, or in 1971, when Richard Nixon severed the last link between the dollar and gold. Since then, money has been floating as a promise from a central bank. As a result, it's very difficult to see huge changes. However, today, I think we may be on the cusp of another monetary revolution as profound as the one that swept away the dollar 50 years ago and the gold standard. And that's the advent of digital money. New forms of digital money can be really transformational. With crypto assets mushrooming, with tech barbarians at the gate wanting to mint their own currencies, and central banks are fearful of what happens next. So as a result, many central banks are thinking about issuing their own central bank digital currencies, or CBDCs for short. In fact, 91 central banks around the world, representing 90% of global GDP, are thinking about issuing a new central bank digital token. And what's at stake is not just the token we choose to use, but the fundamental structure of finance. The structure of banking we've known for the last 800 years could be disrupted by the central banks looking to go direct. Privacy is also another major issue. Big brother central banks could snoop on our transactions or pass that data to the state. Little wonder when the European Central Bank surveyed EU citizens, privacy was their #1 concern from this new form of money. And it also could have a very profound impact on the way and the formation of monetary policy. So these are not small issues at all. My friend Neil Ferguson told me during the financial crisis he wished more central bankers and financiers had studied history and not economics. And I think he was right. So today I want to share with you 3 lessons from financial revolutions past, and also failed revolutions for what I think help us think about the future of money. Now, where are we today with CBDCs? Innovation in central banking often starts in small markets. It was New Zealand in 1990 which introduced inflation targeting, which is now the global standard, even if central banks are struggling somewhat with inflation today. So too, innovation in CBDCs is starting with the small countries. In fact, the best job in central banking today is researching their pilots from the Eastern Caribbean to the Bahamas, from Nigeria to Cambodia. Only China stands out as the large country which is experimenting with these pilots. But none of these were the first. Long, long before Bitcoin was even invented, the world's first central bank digital currency was formed in Finland. And I think it has some really important lessons for those of us feverishly trying to understand what may happen next. So back in 1990, the Finns introduced the Avant card. It was a piece of plastic, but it was central bank money, and you could store up to about $600 on it. At the time, Alexei Grimm, an economist at the Bank of Finland who's done a lot of research on this, said that central bankers genuinely thought it was going to replace cash over the following years. It had a reasonable start. It was used in some shops, parking meters, telephones, but bit by bit it started to struggle. Retailers were frustrated to have a separate piece of kit to try and use these cards. It also was a little bit tricky to reload, and you had to spend money, it cost to actually reload the cards. But much more importantly, as debit and credit cards became cheaper and more available and better, it was they who really replaced cash, not the avant-garde. A couple of years later, the Finns, the central bank, sold this to a consortium of banks, who then chose to close it down a few years later as a flop. In fact, the only thing left of the avant-garde today is you can buy these plastic tokens on eBay for $10. Hardly digital gold. So what does this mean? This leads me to my sort of first lesson from financial revolutions. Think wholesale, not retail. Almost all the successful revolutions created by central banks have been in the wholesale markets, or the backbone of the economy, not retail. In fact, I think central banks shouldn't actually be touching retail investors directly. That's the role of the private sector. One of the challenges with avant-garde was trying to get these cards into the hands of every single Finnish citizen, in every shop, in every parking meter, in every telephone. This is a Herculean challenge. But think today, if a central bank wanted to issue CBDCs and have an account with each of you in the room and beyond, it would require, this again is a mammoth challenge. Every single citizen, but then what about businessmen and women, tourists, children, migrants? The task is too big for a central bank. And that's why, in my view, they're going to need to use banks or other intermediaries in what we think of in banking as a two-tier system. That's what's already happening in China. And a two-tier system at one level is somewhat less revolutionary. But in wholesale banking, here's where some really interesting initiatives are happening well below the radar of what you read in the press. My old boss, Governor Mark Carney, said that central banks should be platforms for innovation. They should be catalyzing the private sector to innovate. And when I was at the Bank of England, I recommended that the central bank should enable new payment systems to have direct access to the central bank money. And I'm delighted to say they're looking into this and it's progressing. And within the next year or two, it's possible that new payment systems can be linked in, and they in turn can experiment. Could be with blockchain, could be decentralized, could be centralized. But at the heart, the central bank is catalyzing this change. Digital dollars and digital euros may be years away, but change to wholesale market is coming far sooner, and we may have a synthetic central bank digital currency within the next couple of years. This leads me to sort of lesson two. Banking is all about access to the central bank. The money we use in the economy is predominantly private money rather than public money. In fact, if you ask yourself how much the money that we use day to day is actually issued by a central bank, it's minuscule. In fact, in the UK, only 3% of the money we use is actually issued by the central bank. 97% is claims upon banks and other regulated institutions. In the US and the EU, it's about 5%. And this means that private money is the dominant form of money in our economy, and we need to be very careful as we start to threaten that system. So, for instance, if the central banks allowed access to new players like tech firms, what would that mean for, say, bank runs? Now, I would certainly worry. Between 1970 and 2007, there were 124 systemic banking crises in the world. Now, central bank digital currencies raise a unique set of issues, but I still think there's history lessons that we can learn about what's happened. For instance, during the Eurozone crisis, Siemens, a German company which has the rare benefit of also having a banking license, hoiked €500 million out of the French banks it was worried about and sheltered it at the ECB. And I do worry that if the CBD is introduced, again, we might see these risks. In fact, the Bank of England, in a research paper recently, suggested as much as 20% of all deposits could flee the banking system in the amount of stress if a CBDC was introduced. Who would then provide the loans? Would the central bank have to step in to prop up the system like the ECB did during the Eurozone crisis? Will tech firms have to replace? These are very deep and difficult issues which we need to think about. But what is clear, financial history shows that who has access is going to be a key fault line for the future of money. At the end of the First World War, French Prime Minister Georges Clemenceau said, "War is too important to be left to the generals. Similarly, I think money is too important to be left just to the central bankers. The issues of privacy, power, and competition are so important, they require a really vigorous public debate about the economy and financial system we want, rather than just a technocratically be imposed upon us. Just like the shifts of tectonic plates create valleys and mountains, so too financial revolutions fundamentally change the topography of finance and our economies. And I think this is something which we underestimate at our peril. For instance, going off the gold standard enabled the innovation of quantitative easing, which has defined the last decade. Or it's also led to the dangerous experiment of negative interest rates in Japan and Europe. Let's not underestimate the change in topography is very real. And before we introduce CBDCs at scale, we need a proper political debate. In fact, to create the Bank of England's monopoly on printing money, it required a Banking Act of 1844, which gave them the sole right to print money, and actually, in their case, squeezed out all the regional banks who used to. And funnily enough, it was that same 1844 Banking Act which gave the bank the tools to stop the banking crisis of 1866, which we saw in which Mary Poppins is based on. So these issues, what are they? It's privacy. Who has access to see our transactions? It's competition. Should the central bank be directly competing with retail banks? It's stability. What happens if the deposits flee? Who's going to prop up the system? And also, how green is our financial system of the future? Because obviously, as we go forward to a lower carbon economy, it's critical that the payment system moves lockstep. These are deep and difficult issues. But for the moment, central bankers are trying to have their cake and eat it. If you look at most of the research papers coming out, it's as if they're trying to create a Goldilocks CBDC. Not too much to destabilize the system, but not too little to be irrelevant. For instance, in the Eurozone, the ECB has suggested that citizens could only have a maximum of 3,000 euros per person. In the Bahamas, there are limits on how many dollars you can move per day. But these restrictions, I think, are very challenging. Is it really worth spending billions and billions to try and create a new set of payment rails for something so limited? And also, the history of finance suggests that network effects are really important. If you use it, I use it, we all use it, there is power in that network. If the central bank digital currency fails to create the network effects, it's of really no value. In my view, a Goldilocks CBDC is probably a fairy tale. And that's why we need a vigorous political debate, not just a technocratic and engineering debate, to think about these innovations and what it means for the future. So what does this mean for the future of money, of banking, and finance? I suspect we're going to see a three-horse race between the central bank digital currencies, but side by side, new private sector tokens, could be Bitcoins and Ethereum, could be stable coins. But the third horse, which I think we shouldn't underestimate, is simply making the current system better, upgrading the messaging standards, improving the cross-border protocols, and making faster payments. And I see these three horses really racing out for in what Chris Giancarlo calls the fight for the future of money. It may be that central banks, worried about destabilizing the system, tread gingerly and actually give the running for stablecoins. And it may well be stablecoins make huge advances in the next couple of years. But don't underestimate regulation. Central banks sometimes want to keep the status quo. They and the governments may look to regulate stablecoin and crypto assets and tread on them. I think it's not given who's going to win, and more importantly, it may vary enormously by country to country. The former German Chancellor, Otto von Bismarck, thought deeply about revolutions. And I think his words get to the nub of the issue. If revolution there is to be, let us undertake it rather than undergo it. I think this is right. The issues of power, privacy, competition, how green the system is, are so important that we can't just let the innovations happen around us. We need to think carefully about the innovation and the regime that we want. The key for me is, will we learn the lessons of financial history as we look to shape the future of money? I hope we succeed. With that, Thank you very much indeed for having me.